Joining us right now for some perspective on the market's reaction to Yellen's news conference is Michael Farr. He is president of Farr, Miller in Washington and a CNBC contributor. We also have Eric Marshall, portfolio manager at Hodges Funds in Dallas. And Michael, did you hear anything that changed your mind about when the Fed would be raising rates yesterday? And did you do anything different with your portfolio as a result?
I tended to agree with Steve. I thought he was pretty much right on. The thing that got me was the shift to the qualitative language. I mean, if you looked at his numbers for the predictions of when rates might hike, there was only about 23% for the first half of 2015, which means 75% or more think that it's going to be second half or later or even into 2016. I don't think that changed. This shift to a qualitative kind of squishy, confused number of what they're going to mean by an employment target, I think added a whole lot of dovish room. It gave them room to say, we're not really worried about the empirical precision here. We've got this general sort of thing we're going to go for, and it lets them ease. So we didn't change yesterday, but I'm still looking for opportunities to buy. And I think that, you know, if, like the weather report, you look out the window to see if it actually snowed when the weatherman said it was going to snow. I've hired 3 people so far this year. Our business is doing pretty well. My neighbors' businesses seem to be doing not great, but better. So, I mean, you know, I think overall the trend is positive here, and I think you stay invested.
Well, let me ask you this. You say you're looking for opportunities to buy. Was yesterday's sell-off one, or you're looking for a bigger sell-off?
I wasn't quite nimble enough to hit that yesterday in the afternoon in the last hour of trading. I would love a bigger sell-off if we could find one. I was hoping that, I think like everyone else, that first 6% sort of dip at the beginning of the year would turn into something a little bit larger, Becky, because it's been hard to buy stocks. I don't think they're cheap. I do have my list. I stay invested, but I'd love to see some lower prices.
Eric, is the Fed calling the shots on this in terms of where the market goes, or do you think that this is the economy that will eventually take over for what the Fed's been doing to stimulate things to this point?
Well, I think that's the important part here is, you know, the Fed is talking about the potential of raising interest rates as a result of a stronger economy, not because inflation is getting away from us here. And the important thing is, as that economy improves, earnings of companies improve, and that's the most important factor in predicting long-term stock prices, is what is the future earnings and what are we willing to pay for those today. And as a mutual fund portfolio manager, I mean, I don't think our individual investment thesis is going to change on any stock because the Fed may raise interest rates in the first part of 2015 versus the second part of 2015. I think as long as it's measured and it's in the face of an improving economy, that should generally be good for equities. And we would look for volatility around this as an opportunity to go in and buy things that we think still make sense from a valuation perspective.
Well, Eric, Brian's right in that rates are going to go up. It's a question of timing on this, but what do you tell people who are looking around trying to figure out if they still ride this bull market for a while, or do you think they need to change where they've been allocating money based on the idea that rates are going to rise?
Well, I think it's pretty hard to find anyone who thought interest rates were going to stay low for forever and ever. And we don't spend a lot of time focusing on trying to predict interest rates, but instead, I would recommend to people to really focus on looking at what's going on in the individual businesses that you're investing in, and are they dependent on having low interest rates in the future, or are they relying on good business decisions by their management teams? Are they well run? And do they have the ability to do well with or without an artificial stimulus from the Fed?
Michael, how about you? What do you like right now?
You know, I continue to like healthcare. I think that that's still a story that's unfolding. We haven't gotten out of the shadow of Obamacare, and we have the powerful demographic, and there's still places there. I continue to like technology stocks. I'm not still comfortable with the banks. I mean, I own a couple. But and then some of the technologies, I mean, some of the new kind of emerging trend stocks. I think the trend towards natural foods and organic foods, those companies are adding margins, and I think that those trends are are here to stay. So different areas, but still no need to swing for the fences in a market like this. Stocks aren't cheap. I don't think they're egregiously overexpensive, but there's risk here, and we haven't had a pullback in over 2 years. That's just too weird for an old hand like me.
All right, so we'll wait for that pullback. Michael, Eric, thank you both for joining us.